Good. Hi. Oh, we're live. Hi, Giuseppe. Welcome to Venture with Grace.
Hi, Grace. Thanks for having me.
Okay, to start the show, I want to give a quick shout out to our sponsor. This episode is brought to you by Alginova. Get ready to ignite your passion for innovation at the fourth annual InnoFest, happening at the iconic Palace of Fine Arts in San Francisco on September 25th and 26th. This two-day event brought to you by Alginova is your chance to dive into the future with industry leaders and cutting-edge startups shaping health tech, AI, clean tech, life science, smart life, mobility, and more. And here's something extra special. I'll be hosting a panel at InnoFest, guiding a dynamic discussion on the future of AI and workforce. Join me along with other thought leaders as we explore the trends and technologies driving innovation and positive change. Don't miss out on this unique opportunity to be part of the conversation and help create a brighter, more innovative tomorrow. Register today at innofest.alginova.com and be part of the movement at InnoFest 2024. Okay, so let's dive in. I want to start with you were a founder before a founder of a fund. So let's talk about I feel like what you shared I thought were like really interesting for me was you went to the basis course at Stanford back in 2021. Maybe we can start there on like what were some core lessons that you've learned um kind of like in your entrepreneurial journey era that you kind of took to build your fund.
Sure. No, for sure. And that was it was 2011. So that was the conference that you mentioned was 13, 14 years ago now. But it definitely was a part of the kind of early realizations that I had at a relatively young age. The technology was really where my heart was, and that I wanted to, dedicate my career to. So I guess if we rewind the clock, was always very curious when it is related to technology. Started building computers at a very young age, back when it was still difficult to do, but I would say it was very difficult back then. There were very little resources, if any, online and so on. And then in my undergrad, though, is really where I acknowledged that this was my future. Two things happened: the iPhone launched and the App Store launched, and so I started to build mobile apps on the side while I was still an undergrad, and then shortly after I graduated BU. And during that period, I also attended various things. One of which, and probably the most notable one, was what you just mentioned, which was this conference that Stanford hosts every year for student entrepreneurs. And they invite some Stanford student entrepreneurs. They invite student entrepreneurs from other universities outside of Stanford. And I forget what I was building exactly. May have been in a student apartment rentals web application, but I applied, I got in, and I met some wonderful people on that journey, some of which have remained peers and friends of mine within technology who went on to build some incredible category defining companies. And in that conference, I realized that, wow, there's this whole other world out there that focuses on building products that solve the world's largest problems. And it was my first time going to Palo Alto in California. So it was this perfect storm of events where I started to build mobile apps on the side. I then started to meet incredible people who also had a shared affinity for building technology. And it kind of just led to me post undergrad, instead of going to work on Wall Street, I then decided to just try and start a company. And after many failed attempts at building various products and projects, one of them stuck. It was called FAM.
Mhm.
We built the company. That was my first standalone software company. My co-founders and I built that company for about 5 years, and it was a heck of a ride. But
Mhm.
that's a little bit of how it all started and why I've ended up in this thing we call tech.
Totally. I feel like so I want to like give the audience a little bit of your background like the company that you have built. So you have raised from some of the most iconic VC funds obviously like NEA, Bessemer, like Index, like Norwest Ventures, like Flagbridge. So a lot of people went on our show, but, a lot of partners of these funds went on our show. But I want to like I feel like that's like a lot of entrepreneurs like dream to have like these investors on the cap table now, like 186 as well. So I wonder, how do you think about like fundraising from a founder's perspective that kind of now you educate your portfolio founders?
For sure. It's a big part of how we support early stage founders at 186 Ventures, and a big part of kind of the of where our advice comes from was, so in part, my prior experiences and background, having been a founder, and to your point, having raised from some fantastic venture capital firms and the GPs and partners and individuals themselves at these firms. So I guess it influences a lot, that experience, and kind of some of the things that we coach founders on are how to think about what the right type of investor is for your business at any given point in time, because firms bring many different fantastic things, depending on their size, depending on their focus, depending on who is at the firm and what the experience set is of those individuals. And so what I ultimately learned was quite a few things, but I think one, early on, it's really important to partner with VCs who are patient and truly understand what it takes to go from 0 to 1. So to go from thinking about building a product to bringing it to market to achieving some level of product market fit. That is a very, very particular problem set in the life cycle of a business, right? And then, of course, as you grow your business, as you hit product market fit, as you think about growing the team further, scaling your sales and go to market efforts, whatever they may be, challenges evolve. And then, of course, the types of investors that are best fit for those challenges evolves too. So it really, from everything from how to capture a VC's attention and be able to understand, what indicators there are to suggest that the VCs are actually interested in you, or maybe they're just dragging you on, all the way to what are the right VCs for you. Hopefully we help our founders try to avoid some of those mistakes.
Totally. I wonder, I really like what you said about like, finding the right investor, and then also like helping the founder identifying, who is actually interested, who is not. I feel like this is such a mystery to everyone. Sometimes people could be getting ghosted for like 5 months and then like eventually heard back it was a yes or something. So it's like you never really know. And I wonder when it comes to like building a fund, since like now, you and your co-founder made like 32 investments, like angel investments per to starting 186 Ventures. That was like, I mean, obviously that was like a lot of investments. Like, so were you kind of like investing out of your own pocket, or did you like kind of invest on behalf of like other people? Like, tell us more about like the funding story of like 186 Ventures and
Sure. Yeah, absolutely. So the genesis of 186 Ventures was first the angel portfolio of my very good friend and I, Julian Fialkow. So he and I met at DraftKings. DraftKings acquired my company, FAM, the one that we were just talking about briefly, in Q2 of 2018. He was an early employee there. And so we first became very good friends through most of 2018. And then by the tail end of 2018, after recognizing that we had and still have, of course, a shared affinity for supporting and guiding founders with advice, we said to ourselves, why don't we start angel investing in some of these founders? So that was the initial idea. And then we named it 186 Ventures over time. And that ended up being the beginning of what was first Julian and I just going around meeting founders, writing angel checks, to now a firm that is invested in north of 60 companies between our angel portfolio and our fund portfolio based in Boston and New York. But it was first angel investing with $15,000, $20,000 checks, then $25,000, $50,000 checks, no outside capital, just our own. And yeah, that was the beginning though.
I wonder, so like first of all, like I like really love like attending like all of you guys like dinner or like happy hours. I feel like you guys have such a great like authentic way to kind of engage with the founder early. And obviously I have like met some like really wonderful founder now, like I'm still like in touch with throughout the event. And I wonder like when it comes to like building a firm, turning yourself from angel investor to a fund, kind of like what was the journey like? What was the kind of like at the beginning among the 32 investments, like, how many of them kind of like, not maybe like, I feel like this is getting into too much detail, but like, without getting into too much detail, like how was like the performance of the first batch of company kind of went that kind of like lead to institutional investors' interest? Because I feel like nowadays a lot of people are fundraising for their own fund, but like not many people succeed because of like, I think it's a really big transition from being a founder to being like an institutionalized capital. And you guys have done such a great job for the first fund to be like 37 million. It was like a um pretty big jump for like a lot of people versus like, I think most people's first fund were like under 5 million. So like, can you kind of share a little bit of like, what are things that you feel like you've done right to kind of like make this happen?
For sure, for sure. Lot of really interesting things baked in there, Grace. And we can kind of pick them apart individually, but they all are very important. And I think one thing you highlighted, which is the transition between being a founder operator or angel investor rather to being an institutional VC where you are playing a meaningful role on a company's cap table. You aren't just writing a bunch of checks in the spray and pray manner, which there are some fund strategies that do that. We just don't believe in it. We don't think that maximizes MOIC. But point being is it's a lot different, right? It's a lot different being able to write a $25,000 check and convincing a founder that they should take your money than you going to a founder and saying, we want to take half of your round or the majority of your round, right?
Mhm.
Very big decision for a founder to part to partner with a VC in that capacity. And we kind of a lot of learnings that we've overcome and that we've been very so far at least successful with. But I guess like going back, so there's a few different, at least two categories of performance, I guess, that we can talk about. There's obviously the quantitative component, right? So we invest in companies, they raise their Series A. If we invest in a seed company, that is, they then raise their Series A or they raise their Series B, they raise follow-on capital. And typically in those cases, the pricing of those startups increases, right? So then we're able to show that we've generated at least an unrealized return, right? In some cases, we actually wrote some later stage angel checks and so on that did realize in some ways. But that's kind of one part of the performance. The other part of the performance is just being able to demonstrate to LPs, so limited partners that we ended up raising capital from for our first fund in late 20 or fall of 2021, is demonstrating an ability that we can access some of the brightest builders and operators before they're discovered in market, right? Because
Mhm.
performance is one thing, right? But sometimes you can be invested in great companies. This wasn't the case for us in 2018, 2019, because we were still in a great market. But let's say you started building an angel track record in 2021 and 2022. It doesn't matter. I mean, unless you picked one of three companies that have really grown that fast and raised multiple follow-on rounds of financing, you won't have much performance to show because we're in a different
Mhm.
market today, right? Where in 2018, 19, I'd argue you could raise an A 12 months, or the average A may have been just 12 or 18 months after raising a seed round. Today, with the market where it is, you need to show a lot more as a founder and as a company to raise your Series A. So you start to see that performance that really is, it's not just dependent on the type of company, but it's also dependent on the market and kind of the velocity at which your performance grows is heavily informed by the macro, whether you like it or not. But we were certainly accessing some incredible talent and builders, right? So coming out of great universities or coming out of great companies. And so we were able to demonstrate to LPs that, hey, even though we've never been full-time investors, we've been in the industry for some time and we've built up enough of a brand and track record in working with founders from at least an advice perspective or even an angel investing perspective where we are going to continue to see some incredible opportunities from XYZ companies or ABC universities. And then I would say the third category of performance, I guess, that we pointed to and still can point to, right? And I would argue is very important for any VC to point to if they're raising capital, for a fund, that is being able to showcase very concrete proof points as to how you made a difference in a founder's trajectory. Because ultimately, especially once you start to develop a fund track record, the smartest founders and the founders that have options and can raise from multiple VCs, right? And sometimes the best companies can't raise from multiple VCs, and that's totally fine. But I think a lot of the times what LPs think about is, okay, Giuseppe and Julian, if you're talking to this company and all these other great VCs are talking to them, why are you going to win? And typically the way you win competitive deals, and at least at the early stage, we're talking about the pre-seed and seed stage, is being able to show founders that you punch way above your weight on a comparative basis to other VCs when it comes down to supporting them. Because as a founder, that's really all you care about. You care about partnering with a great VC that cares about you, that is patient, and that can add real value. And typically that has been in your shoes, right? Not always has to be in your shoes, but that certainly helps. So we were able to, and we continue to be able to showcase that if you talk to our founders, and some of our founders have raised from some incredible other VCs, we are very, very confident that they will say that we, if not the best of the best VCs on their cap table that have helped them raise more financing in the future for their A or their B, or have helped them recruit executives or great team members, have helped them figure out how to set and scale goals, all these really important things that matter when building businesses, we are really, really good at helping founders with. And I would say that is a very, very important point of performance that LPs looked at when we were talking to them in 21, and that they will continue to look at for honestly in perpetuity as we continue to build 186 Ventures.
I wonder, so like I really like what you said about like, having founder reference is like a really strong point. Also like having them picking you versus a lot of like other um traditional or like like brands that like have been around for a while.
Right.
So I wonder when it comes to like um building up the founder pipeline or like diligencing, I feel like number one is like um maybe the diligencing part, like how do you kind of diligence founders in each different categories? Because since you guys come from DraftKings, like I feel like you, and then also based on your personal like experience building fam, I feel like you have a lot of um expertise in like the consumer gaming slash like just consumer technology space. And I wonder, since like right now you guys invest in like a diverse set of portfolio companies, like how do you kind of like demonstrate the value add to the founder? Also, like what does a diligencing process kind of look like for you to invest as a early stage investor? Like do you kind of like run the potential of like, would people invest in XYZ later on, or like how do you kind of like run the diligence process for most of the companies?
Sure. Great questions.
Mhm.
I guess first, you're right. I mean, I think early on, at least in both Julian and I's careers, we spent a lot of our time operating in consumer sectors. Now, I also did spend a good amount of time helping run an AI company called Pison Technology. We were building neural interface hardware and software. So very early on in building AI-enabled sensors, very early on in deploying neural networks before AI became ubiquitous as we now see it.
Mhm.
And in that, all of our use cases were B2B and enterprise, right? So I guess through that, it did learn a lot too. But I think more notably, the peers that Julian and I have, right, and we have built up as a firm, most of them have built enterprise companies. And
Mhm.
a lot of what our job is, especially as pre-seed and seed investors, is to be super curious,
Mhm.
know that we are absolutely never the smartest in the room, and make sure that we are building the best inroads to founders and operators who have built some of the most category defining companies in all industries. And I would say that for a firm that's only been around as institutionally investing for for 3 years, our bench of healthcare experts, of fintech experts, of AI experts at the application layer, and then even at the lower level layers like the developer tooling and the LLM layer, we have a very, very deep bench, and we usually within 24 to 72 hours can get on the phone with whoever we need to get on the phone with in order to become very comfortable and very familiar with what challenges a company is trying to overcome, or whatever else comes with the diligence process. And so that's how we've been able to run and will continue to run a competitive industry agnostic playbook. Because in Fund One alone, Grace, oftentimes it shocks people, but to us, it just kind of makes sense. Fund One, 85% of our portfolio is B2B. So believe it or not, we actually have not done much consumer. We have become more comfortable, and we have found some of our fastest growing companies to be within fintech, to be within AI, to be within healthcare. And so we strongly believe that being industry agnostic is the way you maximize investor MOIC at the pre-seed and seed stage. And we've built a very, very good platform and operation around myself and Julian. And we have a third incredible team member, Sophie Panarese, who has helped us do a lot of that and helps us do a lot of that, which allows us to be very curious and able to learn about whatever we need to learn about when an incredible founder comes through the door or hops on Zoom, right? Now, if we segue into diligence, and it's very, very tightly, connected with what I was just talking about. But if we think about how do we diligence companies, there's many different angles that we can kind of approach this question from, right? One, whether, I guess there are nuances in the type of technology that you build, but we've seen a lot of technology and a lot of products be built, whether it be from a consumer perspective or all the way to a hardware perspective, whether it be building AI intensive products or ones that maybe don't leverage any machine learning. So we've actually done all that ourselves. And so just being able to understand whether a product, most of the time, not all of the time, but I would say the majority of the time, be able to understand whether the technology that's being built is sound, and if the team has the ability to do it, we don't have to, call people outside of the firm. We're able to really do a lot of that ourselves, which is a huge advantage, right? Because we're able to move a lot faster early on than I would argue many others who maybe don't have that technical DNA in the firm. But if we kind of go beyond that, it comes down to kind of two buckets of how we view the world and we assess companies. One is looking at it more from a first principles perspective, which is what we call the idiosyncratic phenomenon. So one, what is very idiosyncratic about the team or the founder? Right? Why are they so obsessed with this problem set? What is their background? What is their superpower? How do they view the world? And we look at all those things, and we, on a comparative basis, look at the other founders that we've spoken to tackling such a problem set, and we think to ourselves, of the incumbent companies out there, of other startups trying this is actually the most idiosyncratic set of superpowers and approaches that we've seen. Okay, great. So we look for that. And then we also look for a clear why this is possible today and may have not been possible before, right? Now, that doesn't mean that we have any particular understanding of market timing. We're not that smart. We don't have a market timing crystal ball, right? I'd argue any VC who says they do, I would challenge their calculus there. But we do like to try and understand, was there some technical shift that occurred or some regulatory shift or some market shift that has occurred in recent time that now lays the groundwork for these super unique idiosyncratic founders that have some superpower to be able to build something special that industry has never seen before. So we think about that. Those are all the first principles, and there are more. And then we marry that paradigm of thinking with the fundamentals. So there are four things that every incredible business has. One, a team. It's always the most important thing, but the team. Two, the market is large enough and ripe enough for a fast-growing large company to be built. 3, the economics and the business model make sense, right? So it's a sustainable business that's being built, not just one that can generate tons of gross revenue, but one that can actually have a profit at some point because there are margins that make sense, right? Not that we look for profitability early on. It's quite the contrary. Most companies we invest in are not profitable, but we like to understand that there is a path to sustainable unit economics because being capital efficient, it becomes very important, if not at the very beginning, right? And we obviously saw after the 2021 market shift, if you didn't have a sustainable business model, you probably weren't going to make it and are not going to make it. And then lastly, moat and differentiation, right? So you have businesses that have those 4 things, and then we like to look at it through a super early pre-seed seed lens of what is very unique about this founder. Why are they the absolute best at something in particular relative to the competition? And why is now the time to build something that could really change the world?
I wonder, so I really agree with you on like, finding the right team and like, and then figure out like if the market is big enough, and then also like if the market's ripe enough for to like kind of like accept this kind of product, and then eventually will they have like a path to succeed as from like the profit margin perspective. I wonder when it comes to like building up the founder pipeline, like what's kind of your approach, or like what's like a 186 approach different than like, many of the people out there. So I feel like nowadays, like a lot of like, so we have some LPs came on our show, and I feel like people are looking for some sort of like sustainable pipeline
Sure.
generation. Like what's your kind of like thought process of building like a differentiated like deal generation
Yeah, no, of course.
process?
So it's a very interesting question because we
Mhm,
talk about it a lot internally.
mhm,
And it's multifaceted, right? Because
mhm,
sure, we can point to specific networks,
mhm,
the DraftKings network, or let's say the AI network, and the companies that we've worked at or helped build. And sure, we're going to see a constant pipeline of builders that come out of there before others, right? But the way that instead we like to look at it is that is more enduring, more consistent, is the combination of things that we have been able to institutionalize and have a constant access to, right?
mhm,
So the founders that we've invested in, which now, we invested in over 60 founding teams between our angel portfolio and our fund portfolio. Many of those founders have raised from many different funds, and they would argue that we add the most value. And so founders are usually the ones that we've invested in are sending us operators that come to them for advice or that come out of their companies before they send them to other VCs, right? So there's a bit of differentiation there where we're seeing deals in that case before others. Number 2, Julian and I's own direct networks. We've rubbed elbows with people and continue to rub elbows with people that have built category defining companies, some of which are good friends of ours, some of which are LPs of ours. And so through that, we're usually getting the first email or call from those folks whenever they hear someone leaving their respective companies. And number 3, a lot of our programming. So we don't just rely on our networks. And I think that it's hard to scale just being able to say, oh, everyone that comes out of XYZ company, we're going to see. Sounds great, but is that going to scale for 3 or 4 decades, right? No. What will scale is building a vibrant community activation pillar where we are known within the industry. And to be clear, we focus on the Boston, New York corridor, right? So we're very, very active within the Boston and New York communities, respectively, with hosting vibrant, eclectic, differentiated founder operator programming, right? That doesn't mean we throw the best events all the time,
mhm,
but we're very active, arguably one of the most active in Boston for sure. Where in 2023 alone, we hosted between those 2 cities primarily, and to a lesser extent, San Francisco, where you've been to some of our events,
mhm,
Grace. where we had over 50 events and showcasing over 3,500 unique founders and operators, right? So just in the numbers, we are extremely present in these ecosystems. Now, how it all ties together is what I alluded to earlier. In the East Coast, at least, lesser extent to the West Coast, I think it's more culturally embedded. But in the East Coast, we do not have enough true founder operator aligned pre-seed and seed investors. And as long as that is the case, and we think it will be the case for some time, our support, in our opinion, will shine and it will build a brand for ourselves. And so, why am I saying that? Because many of the best deals that we have done and that come to us are because we are known for the amount of value we add to a company, oftentimes even before we decide to invest. And so that is our differentiator. If I were to pick one thing, the most important differentiator is that if you ask a set of founders that know a bunch of different firms, we're very, including us, especially as we've invested in, we're confident that we will be, near the top of the list, at least, of ones that can add a lot of value because of just the platform that we've built, our own know-how, and the network that we extend to our founders.
Mm. You just talk about, like, I feel like it's really impressive to even, like, do one event, but not the list, like, 50 events throughout the years. Like, I wonder, how do you really, like, um, kind of evaluate, like, which event will make sense from, like, a deal flow perspective, and or, like, that's not, like, necessarily the benchmark? Because I think the other thing that I found really interesting was, like you mentioned, like in the East Coast, maybe there's not many pre-seed seed investors that are kind of actually contributing a lot of value to the ecosystem. Like, how do you define, or like how do you kind of, I think you also use like institutionalized pre-seed seed, like, or like institutionalized like investor, early stage investor, and like some other podcasts. How do you think about like adding value, but also like proving the kind of short-term and long-term rewards from like the deal flow or deal quality perspective?
Sure. So, and to be clear, I do think that there are a lot of firms in the East Coast that add value, more so
Sure.
from
Yeah.
a founder perspective, being able to kind of look a founder in the eye and relate to them as a founder. I think
Yeah.
that's
Yeah. Yeah.
isn't as prevalent, but you bring up a lot of interesting considerations. I think from a event quality perspective, right? Or how do
Mhm.
we think about, and primarily, Sophie and our team, thinks the most about this out of us three. But how do we think about maximizing ROI on any of the time that we spend running events? And it depends on the format of event, right? Because if you take all of our events, obviously the end goal is generate deal flow, right? That's the most important goal, at least. But there are many other goals too, right? Like
Mhm.
support our portfolio company. Some of our founders have found some customers at our events, some
Mhm.
of their biggest customers. Some of our founders have recruited some of their best talent at our events, right? So there's a
Mhm.
whole portfolio support element too that maybe isn't as obvious. Um, but ultimately, the way we think about it is, if it's, let's say, a dinner that's curated,
Mhm.
right? All of our dinners are curated, and it's a founder and operator one in particular. In that case, we're very strategic about who sits near who, right? I mean, not
Mhm.
always, but sometimes. And so what we try to do with that is we think very deeply about, okay, if it's some of our founders at this dinner, obviously we want to see if there's anyone coming that can benefit them, and vice versa. But sometimes too, it's just someone we know that is thinking of starting a company looking for a co-founder. So we'll seat them or sit them across from someone who can be that, right? So
Mhm.
so a lot of these events are, in some cases, if it's an open-ended happy hour, sure, maybe we want to meet founders we haven't met before. If it's a curated dinner, we probably know everyone there. Maybe someone that we're getting to know, potentially considering investing in, or maybe it's just a bunch of our founders and we're trying to get them in front of an important cohort of customers or talent, right? So it all really depends. And then I guess the another reason and way that we think about ROI on our programming is the just brand recognition, right? It is important sometimes, when, not all the time, but sometimes when a founder speaks to you, they've heard about your firm, right? Because A decade ago, there weren't many VCs or as many there are today. Today, there are many. So it is important to have every little bit of edge going into a first call with a founder where they may have been to one of your events or they've heard of your events.
Mhm.
And that way, you're more of a known entity. And now, not that that's that big of a deal, but every little bit counts, as you know, and given how competitive the industry is.
Yeah, 100%. And I feel like you guys also gave out like the really great energy that I feel like each event I've been to, like you and Julian were like so friendly. And I really appreciate that like you guys kind of like built the relationship without like you needing something from the person. Like I feel like it's a truly authentic relationship. And I wonder when it comes to like like thank you, but I wonder when it comes to like as you know, like you just mentioned like, you guys have like Sophie to run like some of the events and like I wonder in terms of building up the fund, besides like having good investing arm. So like how do you think about like growing the firm as a firm? Also like the different programming. Like so is this like typically just like happy hour or dinner or like is there actually maybe like a founder coaching program or like some sort of like fundraising boot camp? Like how does it look like from like the support angle to systematically support a lot of founders since you mentioned like a lot of founders will give like amazing reviews for the fund, like how do you kind of like scale the effort of helping a company grow?
Yeah. This is probably the it concerns a strong word, but if I were to say one thing that is a top of mind, it's how do we scale our portfolio support? It's
Mhm,
actually in terms of scaling deal origination, both from a sourcing perspective and deal making perspective. We're actually not very worried about that because we've built out a very, very efficient
mhm,
and effective investment process that allows us to move very quickly on diligence and be able
mhm,
to juggle multiple deals in tandem. And we'll obviously be hiring more investment team members as we, let's get, raise fund two and beyond. But I would say on the portfolio support side, we do currently approach things in a systemic way,
mhm,
knowing that we will need to scale these things, right?
mhm,
So there's maybe two or three things that we have built, or two or three wavelengths of portfolio support. The
mhm,
first is a passive knowledge base, right? And Sophie gets the credit for this one, where she's built out an incredible knowledge base to be able to direct founders towards accountants that they may want to use or venture debt providers that they should start getting to know, or whatever else may come up in the course of building a business that doesn't require a 2-hour working session, right?
mhm,
And so we have developed close relationships with some great service providers that work with startups that we're able to very seamlessly connect our founders with, executive coaches including, right? Things like that, where instead of having to drop everything and go find out who should we introduce the founder to, it's we've done a lot of upfront work to have a lot of these things ready. Okay, so there's that. Number one. Number two, the way that regardless of whether we have 10 portfolio companies, 50 or 200, we have a pretty seamless process in the way that we aggregate data from our
mhm,
company. So on a quarterly basis, we have a pretty neat questionnaire in a very, very formatted structure that allows us to understand what's going on at the company, right? And it's literally less than one slide worth of data.
mhm,
It's cash on hand, runway, revenue. What goals did you hit? What goals did you miss? What three things are top of mind? Simple things like that a founder that knows their business, and hopefully all of our founders know their business, can
mhm,
probably fill out off the top of their head in a matter of 2 or 3 minutes every 3 months, right? So we get all that data. And obviously, one of the big questions there is what are three ways you want us to help you, right? And then we're able to take all that in and in a very sequenced, efficient manner, get through a lot of the things that we need to do with founders. So those two things are pretty systemic and they allow us to triage the far majority of portfolio support.
Mm.
Now, where it gets interesting is the high touch stuff. This stuff, I'm convinced, we've only been doing this for full time for 3 years, but having built companies too and working with VCs, I am convinced that there is an element of supporting founders that need not be complicated, but at the same time needs to be high touch. So,
Mhm.
for example, Giuseppe, Julian, Sophie, I'm thinking about going out for my Series A. What investors do you suggest? That really just can't be answered via email, right? Or at least I don't think it should be. That should be a phone call, right? So things like that are very expensive from a time perspective. But I do believe that it isn't rocket science, right? And because we only focus on the formative stages of company development, we're able to talk through very complex company building problems and issues very efficiently and very quickly. And because we do it so often, we're able to get through a lot of that. So that typically means one of myself or Julian and maybe even Sophie need to hop on a call, whether it's a 10-minute call, a half an hour call, and we just get it over with. And so that's where a lot of the risk lies. But we have a lot of our support frameworked in such that we can answer most complicated topics even over the phone very efficiently. And as we, build out the team, we're keeping in mind the amount of bandwidth required to triage the high touch scenarios because that's the bottleneck here, right?
Mhm.
And we have no reason to believe that we won't be able to stay on top of that.
I wonder, I really like what you said about like maybe like having the founder to give you like, hey, like what are the three things that you need right now at the moment? But what if like you encounter a founder that like just constantly asking you for help? Like let's say you introduce them to three investors and then they're like, hey, can you introduce me to blah blah blah? Or like, can you promote us to blah 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 community? Or how do you think about like if a founder is like over dependent on your kind of,
Mm,
like, on your, help, basically.
I know, I see what you're saying. This is going to sound crass.
Mhm,
Having been a founder, though, I think I get to say it. That means we invested in the wrong founder.
mm,
Because when we think about founder DNA and founder profiles, now to be
mhm,
very clear, and I think I've spent
mhm,
now 40 minutes talking about how much value we add to founders, we definitely don't discourage our founders and never would even think of discouraging our
mhm,
founders to ask us for help, right? But when we screen builders and screen founders ahead of making an investment decision, we think very deeply about, their own just general conviction in their abilities to problem solve,
mhm,
right? And so we don't have a perfect formula for this, but in getting to know a founder and a builder, you start to get a sense of what they would be like to work with. You start to get a sense of, how much of a self-starter are they that they're able to figure stuff out. Because and this is not, we're not the only ones to say this, but typically the best founders, they just
mhm,
figure stuff out, right? As much as we VCs like to say that we add all this value and we're that important to a founder's journey, a founder either figures out how to build a great business or they do not. And it's that simple. And I do think, though, along the trajectory of building a company, VCs can be particularly helpful and they can lead to a particular step function in whether it be financing strategy or whatever else, step function improvement that is. But we're not doing rocket science here. So we like to partner with founders that will have conviction in their abilities, know when to ask for help, but at the same time have enough self-starter ability where they're not going to depend on anyone, never mind their VCs, but anyone for, building their business, because that's what makes the business special is that the founders are doing most of it.
mm. What about like, I really like what you said about, like, I really like that what you have, like, you're, like, self-aware, like, if the person is, like, asking for too much, like, it's kind of like, um, the VC is on the wrong end of it, and I wonder, what if it's, like, the opposite? If, like, you invest in a founder and you never hear from them ever again, or
Oh,
like
okay.
maybe you reach out to them and they're like, yeah, we're all good, and like there's no progress update or
Mhm.
just like proper communication in general, like all the phone calls are gone. So like I wonder how do you think about the opposite of direction on the early stage where a
Yeah.
founder is just like not needing anything and it's kind of gone.
Yeah. I'll start by saying I think our best companies and founders historically have been ones that have been consistent about investor comms.
Mhm,
Now, I don't think it's a good use of a founder's time to spend a lot of their bandwidth and just mental headspace thinking about what to put in an investor email, right?
mhm,
We encourage our founders to keep things very simple, right? And we provide examples of simple templates of how to keep investors apprised on either a monthly or on a quarterly basis. So we've seen there's a correlation between founders that stick to their comms and don't go dark when things are going bad to the companies
mhm,
that are most successful. Now, with all that said, yes, unfortunately, we have run into instances, and I think every investor does, where I think mainly in our angel portfolio and our fund portfolio, this hasn't happened really because one thing I mentioned earlier, Grace, we do have that quarterly questionnaire that we issue.
mhm,
So whether our founders spend the time to send out a monthly update or a quarterly update, and whether they're consistent on it or not, we are collecting very important, pertinent information and data on our portcos on a quarterly basis. So they can't really go dark. I mean, they can. They could ignore that too. But then again, I would say, wow, we really partnered with the wrong person, right? So
mhm,
thankfully, none of our founders, ignore us, right? But some have different, investor relations cadences they like to stick to. And it also depends on the stage of company, right?
mhm,
If we invested in one founder, and this happens, right? We invested in a founder and they're literally by themselves and they just have money and a bank account and a bunch of code up on their GitHub and they're building. I mean, don't send us a monthly update. Like, like, what's the point of that, right? Please spend the extra time and just build your company because you're so early, right? And typically, there are other touch points too where we'll see founders at events that we host, or we'll have a working session call that's booked out 2 months out. So it's very rare and never happens where founders go totally dark on us, especially within our fund portfolio because of
mhm,
expectations that we have set and honestly, because of the types of people that we like to partner with, right? We like to think that
mhm,
we screen for intellectual honesty. Because that's really what we're talking about here, right? If we're talking about whether a founder stops sending updates or not, it's a question of, barring them having some physical constraint, it's how intellectually honest are they being with their progress?
mm. I wanna maybe like I really like what you said about like, no matter what they do, you kind of like have a cadence to keep sending them the question. Oh, like I mean like the quarterly questionnaire, so like
Sure.
staying in touch. From like an investor building a fund as like a founder of a fund perspective, how do you kind of like manage your like LP relationship? Obviously, like give whatever you can, not like I
Mhm.
don't want to get into too much details, but like
Of course.
in general, like, how does that kind of like LP management side of things look like since like the fund is like pretty much still in the early stage and like um some funds like some like longer term or like I guess like if some fund have like let's call it like a 20-year fund or something, like they have like a person dedicated to this kind of task to like
Yeah.
manage the LP relationship. But like as a um I don't know if you identify yourself as an emerging manager, but as a um call it like fund one, fund two, like how do you kind of manage you know, the a lot of like LPs in general? So like I mean some of our like past guests mentioned like they would maybe like having like 1,000 meeting and then land to like 100 investors, but like how do you kind of manage the 100 investors that you have in the
Sure.
pipeline to um like do the LP updates or like even staying in touch with them to maintain a good relationship?
Sure. Sure. No, it's a great question. I think it's one that a lot of we and our peers, a lot of our peers think about.
Mhm,
Um, for us, we're very, very transparent and candid. We send out a quarterly letter that is, it's not a 10-page letter, right? Because we want to make
mhm,
sure that it's succinct and something that our LPs look forward to reading and that they're able to absorb, because it's really important for us to know that they are able to absorb what's on our minds, right? So effective communication sometimes being more succinct, right? If we were, I don't know, if we were a $40 billion fund, maybe we'd be sending out, the 20, 30 page notes, right? But I think a part of it is having a quarterly cadence and having communication that is very effective, very succinct, very candid, very open. And we do a great job of that. And we put a lot of time into thinking about how to describe our new investments, right? We provide color on anytime we make a new investment or anytime a company is, let's say, marked up or marked down. We provide very specific color as to why we invested, why we're excited, why the company's doing well, why the company's not doing well, right? And so we do that on a quarterly basis. We also hold an annual event where it's virtual, where we invite our LPs to kind of just get a high level summary of how things are going, more in a live format. We also invite some of our founders and sometimes some experts to be interviewed and to kind of give our LPs as much visibility as possible as to what we're seeing on the ground floor. And then we always make ourselves accessible, right? I think that we do have conversations with LPs, as we're raising and as we go into launching a fund, where in terms of what to expect from a communications perspective, we make it very clear that we're always accessible. And we always want to make sure that we're providing the level of transparency that an LP would want. And we make it clear that we try to achieve as much of that as possible through our quarterly cadence of letters and emails that go out and whatever else. And then, of course, there are sometimes LPs that will require a direct conversation for whatever reason. And one of Julian and I, and sometimes both of us, make ourselves available for that. But I would say because we do a pretty good job with the quarterly stuff, we don't find ourselves too inundated, if ever at all, with LP, questions beyond email.
I love that. I feel like hosting a virtual AGM is definitely a good way to go, since I feel like a lot of people maybe in a global, maybe in different places globally, and then it's really expensive to fly in for everybody to have a
Right.
gathering like that. And I feel like it's efficient to spend money on the more important things, which is investing and doing all that kind of stuff. I want to be mindful of the time. I want to maybe keep one real question and then we'll jump into a quick 1 minute fire round.
Sure.
So I wonder, when you are thinking about, I wonder when you are thinking about building a great LP base or LP construction. I don't know if there's a word for it. So obviously you guys have done such a great job as for a lot of your past I feel like maybe the past colleague from DraftKings are your LPs on your website. Obviously they're advisors or LPs for the fund, and that's a great indicator. How do you kind of branch out from people who are not in your existing network to invest in the fund? Maybe it's the first time they're hearing about you and Julian, and maybe they have not worked with you. How do you kind of convince the new people who are just getting to know you?
Sure. Well, a lot of it is network, and my co-founder Julian. I have to give him so much credit for how well networked he is. We both are, but he's done an incredible job at expanding our network when it comes to meeting new potential capital partners, whether short term, long term. And Sophie too, as well, has been very supportive in helping us kind of expand our network there mechanically. Now, in terms of the types, we're talking about institutions, endowments, fund of funds, family offices, and each of them do think differently, right? I do think that there's a difference, not always, but oftentimes you'll find there's a difference in terms of how a family office will underwrite managers, especially younger ones, in their company life cycle, firm life cycle, like Julian and I. And I find that institutions care a lot about how you scale the firm and how you scale portfolio support efforts. Honestly, a lot of the questions you asked, Grace.
Mhm.
And then a lot of FOs would, not that they don't care about those things, but maybe they'll index much more heavily on, why are you sourcing better founders than, the other firms, right? So it really
Mhm.
depends, but ultimately they're all getting at the same questions. And how do we convince them? I mean, we just do a good job with founders. I mean, at the end of the day, obviously a big part of fundraising is having the right narrative and being marketable and having the right story. And that takes time to refine.
Mhm.
But we strongly believe at 186, we keep our heads down. We treat founders with care and respect. We pick the right founders. We help companies grow. Then it
Mhm.
all work itself out. And ultimately, we use a lot of those examples of what I just said to convince LPs that we're doing a very great job. And, if you're looking at it over a 20 to 40-year horizon and you're looking for a new firm to maybe be that next generational franchise, a lot of good proof points that we speak to that can suggest that that's the case.
Mm. Amazing. I want to be mindful of the time. We're in the last quick 1 minute fire round for you.
Sure.
What's your favorite book?
Ooh, Founders at Work.
Uh oh wow, that's an OG book. Who made the biggest impact in your career?
Oh, that's a tough one. There's so many people. I would say all of the founders that I've worked with personally. So Frank Udicciani, Kevin Flynn, and now Julian Fialkow. They've helped make me a better person every day and working and so on.
Who would you invite to your dinner party?
Who would invite to my dinner party? I would say is one person or multiple people.
It's your party.
It's my part here. You're right. That's a good point. Um, I would say some of my founders, if we could reincarnate people, always wanted to meet Steve Jobs, just talk to him about various aspects of how he thinks about culture and firm development or company development. And then maybe Obama.
Amazing. Where can we find you outside work?
Where can you, hanging out with my parents or my
Oh, wow.
wife or my family outside of work. Or, yeah, probably.
Amazing. Giuseppe, thank you so much for coming on the show. It was so fun to catching up.
Likewise, Grace. Thanks so much for the time. This was a lot of fun. Thanks.
Okay, let me quickly end